problems ever since I was a kid. It was after university, I left and worked at a place called McKinsey. I knew I wanted to go and build a business, but I felt that maybe I could learn something from other people along the way that might help me build a bigger, better business that I think was a worthwhile endeavor.
How do you advise people to find co-founders?
It was just unfathomable that I would go and meet someone that I'd never worked with before and then start working with them in such a deep way.
Can you give us some context? How were the first 3 months in GoCardless?
Honestly, if you took the things that you should do in order to build a business and be successful, then we probably did the absolute opposite.
At what point did you know that it's going to be a big business, and how did you tell?
Our customers knew before we did.
How does investing change between being an angel to being a VC?
It's much harder. Here's the honest answer.
What should students work on?
Find stuff you're good at and you enjoy, because you'll love doing it, you'll want to do it, you'll invest your time, you'll get great at it, and that tends to be how you become successful and you enjoy yourself.
Okay, guys, I'm Kyriakos. I'm the CEO of Terra. A few years ago, I was studying here, and one of the problems I faced was there was not a lot of mentorship when it comes to startups. So there was a lot of information that I couldn't find from the startup ecosystem. So a few years later, Matt is one of the best in the world at that. So thanks for joining. For our introduction, Matt studied at Oxford, I believe, at the beginning. Then launched a company called GoCardless, which is $1 billion company right now. Also launched Nested, raised hundreds of millions of dollars, very well known in the UK too. And then now is a partner in Accel, probably, if not the best fund in the world. So welcome.
Nice to be here.
Let's go a bit back. How did you start the company? How did you start GoCardless at the beginning?
I'd always loved kind of businesses, and I'd always built stuff and loved solving problems ever since I was a kid. Even at school, I was part of a business that we built, and I find often lots of it's not everyone, but lots of entrepreneurs you talk to, like you just go back in their history and you'll find something. It doesn't have to be a business. It might just be they started an alternative tuck shop at school, or they were selling, cards and making money or whatever. Everyone just, you find this little entrepreneurial spark, and I always had that. I was always doing things like that. And the fascination was always with solving problems, especially problems that other people didn't think could be solved. And then to the question on GoCardless, I think I met some amazing people. So after university, I left and worked at a place called McKinsey. I knew I wanted to go and build a business, but I felt, or luckily enough, I was just about smart enough to figure out that maybe I could learn something from other people along the way that might help me build a bigger, better business that I think was a worthwhile endeavor. But whilst there, I knew I wanted to go and start something. I found some amazing people I wanted to start something with. And I think that's for me, the key. I found some people I wanted to start something with. And actually, there's different ways of starting companies, but in all honesty, we were more in love with the idea of starting and building a great company than solving that particular problem.
I think in general perception in Imperial was that everyone needs to join McKinsey before starting a business. What do you think?
I disagree. And any rule like that is probably not true. I think the thing for me is just figuring out what you need to get where you're going, but not. I really dislike these paths of stepping stones. I really dislike, I know I want to go and do that, and therefore I'm going to go and do like this along the way to get there. And I always just really fearful that you figure out along that path that you never wanted to get to that thing in the end. It's like you wasted all that time doing other things to get there. So I had a friend, funnily enough, he got in touch with me when I just started GoCardless, and he thought he wanted to go become a consultant. And he said, hey, someone from school said that you'd worked at McKinsey. I want to chat to you about getting into consultancy. I really want to go and do consultancy because I'd like to go and start a business. And I said, well, it was a fantastic experience for me. I learned a ton, met some amazing people. That if I wanted to go and start a business, that is probably not the thing that I would necessarily do. If you want to go start a business, again, I think about the things you need. For me, it was great because I needed to prove and learn a work ethic. I needed to build a network. I needed some kind of concrete skills because I had none. And that was perfect for that point in my career. But for him, actually, he had many of those things already. The two most interesting things for him to do, one was either to go and join a business and learn what one might look like, a growth business. And he went and joined a fab company called Skyscanner, had an amazing experience there. And the second one was he was ready. He could have gone and started something. So I think the key is really to think about actually what are the things you want in life, like what you need, and then go get them.
And how did you meet your co-founders?
Met Hiroki at McKinsey, so we worked together. And that is a great thing about working in talent hubs or studying in talent hubs. Funnily enough, our first conversation was at a welcome dinner before joining, where we had an argument about whether you needed co-founders or not to start a business. Let's say
What's the answer there?
he won that argument, but it's the only one since. I think it really depends on the business you're building, but for me, you definitely want co-founders. When I think about the stuff I care about in life, fun, learning, and impact, I've been really fortunate to have some amazing co-founders in the business I've built, and I've had the most fun when I've been working with those guys. All the terrible things that happened felt a lot less bad as well when I had those guys around. I learned the most probably from them and with them, and because they were there, and had the most impact again when we were working together. So I think they're just an accelerant for being successful. But you did YC. I think YC has a great rule on this, which is, 2 or 3 great two or three great co-founders is great, but actually like one co-founder is better than 2 bad co-founders. If it's not going to stick together, if it's not going to work, then you shouldn't try and force it.
And on that, it's a small parenthesis. How would you advise people to find co-founders?
Tough question. I'm contrarian on a lot of things, so you should be careful about what you listen to from me, but hopefully it's like an interesting data point. I really dislike networking. I hate going to an event with 200 people and chatting to them for 30 seconds each, and I just find that really superficial and not very meaningful or valuable. What I love is leaning into real relationships. So for many people, when they want to look for co-founders, and again, it really depends on you. Everything is on you and how you operate and where you get your energy from and how you work. But for me, that doesn't work. So for me, going to get co-founders, it was just unfathomable that I would go and meet someone that I'd never worked with before and then start working with them in such a deep way. For other people, that's worked incredibly well. So I took a really simple process. People I work with, again, simple rules. I look for people I trust, people I like, and people I respect or I rate. There's a deliberate order there because there's nothing more dangerous than someone who's really smart but you can't trust. And I just looked at my network and I went through all the people I knew, and I went through and made a list of, okay, who do I know that I trust, that I like, and that I respect, and like deeply on each of those axes. And again, I'm contrarian. I like that approach leads you to a very short list. I had probably 3 people. I was like, great, I'm just going to go and spend more time with these people and talk to them and figure out where they're at, and if the timing is right, then we're going to make something happen. And both times that worked out fantastically well for me. But again, that's an approach. Other people have different approaches.
And can you give us some context? How were the first 3 months in GoCardless?
God, this is a long time ago. The best summary I can give is we didn't know what the hell we were doing. Like, honestly, if you took the things that you should do in order to build a business and be successful, then we probably did the absolute opposite. We were running around. I remember one thing we did. We had so much fun, though, I should be clear, and that's really important. One of the things we did in the first few months was we went, for some unknown reason, decided we needed more manpower. So we went back to Oxford for like a week and interviewed a ton of interns. We hired like an army of interns. We hired like 8 interns to come and work with us over the course of the summer, and they were all exceptional. And actually, it turns out we were quite good at hiring because they've all gone on to do like fantastic things. But it meant that we were now spending all of our time managing the interns as opposed to doing the things that we should actually be doing to build a business. And some funny stories at the time. We rented like a small house for them. I think there were 8 of them, and we could only get a place with like 6 bedrooms. So we didn't end up telling them there were only 6 bedrooms. And it's when we got there with the 8, we're like, "Hi guys, drop you off here." And I don't know what happened when the moment they were like, "Okay, there's only 6 bedrooms here." And then they come into our house every day. We had so much fun. It was an amazing time, but we got in trouble because we were living in a flat and we were working out of our flat, and we had these like 8, there must be like 10 of us or 11 of us in this house every day. And they obviously figured out that we were running some kind of business out there, which was in breach of our tenancy. And the guy came and said, hey, we were going in big trouble, da, da, da. And I said, well, what do you mean? He said, well, you're obviously running a business. You got all these people on laptops and all that. I said, what are you talking about? We just really like mass multiplayer online games. Like, we're in there gaming all day. And we obviously look nerdy enough that could plausibly be true. So we didn't know what the hell we were doing. And this is the advantage actually of going and working in a startup with great people, as you learn what it should look like. We were building a startup blind. We'd never seen a startup. We didn't even know what it should look like. And there's advantage to that. Naivety is a beautiful strength. We had this vision of nirvana from what we'd read about the companies in San Francisco and what they looked like and how they operated. And there's probably some dissonance between what we read in the books and how we imagined it, but that's kind of what we were building. But what I would say we did get right is we were ambitious, and we prioritized the thing that we felt mattered. At that time, we felt like we were a product first organization. We felt like if you found a problem and you built the best product and continue to invest in that, and actually the way to build the best product is to build the best product team, then you could be successful in the long run. And that at the time was when, we won't even remember this, but that was at a time when engineering and product were kind of second-class citizens. They were like IT. They were the guys in the cupboard who did stuff for you. And actually we had this different approach where we prioritized those things. And that even started with the interns we hired. They were all technical and smart and more product oriented. And that was something that transpired, even though there were missteps along the way. If you get those core instincts right, then over the long run, they can take you to good places.
How early did you join YC? And it's a separate question. Should one join YC? And also maybe should you raise money early as well?
3 questions. And you know what I had 4, because I had the last one. You said, what were we doing in the first 3 months? I think this is interesting because maybe if anyone is thinking about starting something, the first thing we did was we had to come up with an idea, because we didn't have one. We were people first as opposed to idea first. And initially it was Hiroki and myself. So we were coming up with ideas, and we spent like a couple of weeks coming up with ideas and being really creative and thoughtful. And then we'd set aside a day to kind of prosecute each of these ideas. And our main learning at that point was, there's no idea that 2 smart people can't tear apart in a day. We came up with some businesses. We came up with the idea for, and I'm not claiming credit because we didn't build it, and sure, we couldn't have built it, but we came up with an idea loosely that was Funding Circle, one that was Deliveroo, various other ideas that have gone on to be really successful businesses. But we just, you look at anything hard enough, you tear it apart. And I think an interesting insight from that was, actually, it's not about the 999 reasons why it might not work. It always comes down to like the 1 or 2 reasons why it might work. And they have to be incredibly powerful, like core insights that drive everything else. So like, if I'm right about this one thing, then everything else will fall into place. So that I think is like what you should be focusing on when you start a business. Like finding a core insight that if you're right on, then there's real value there. And then to your...
Before you go to that question, like a lot of people are either choosing one idea and they are not flexible at all. And there, on the other side, there is what we call pivot hill, that people are changing the idea all the times. So how do you know when to choose and which one to go for?
Which approach or which idea?
Which idea to go with?
You don't. It's really tough, and it's almost impossible to know upfront. It's kind of an irrational endeavor, right? You believe that with less resource in every sense, less money, less people, less credibility, less experience, less everything, you're going to go and beat all these businesses, at something particular. So it's kind of irrational from the get-go to expect a rational answer, that this is clearly going to be right is very, very difficult. The way I would think about it more is you want to find, I think, kind of founder market or founder idea fit of genuinely you want to do something where you're incredibly well placed to do it. If you can't think of a good reason why you should be doing it and others can't, then that's a bad signal. And I think it's exponentially harder for you to be successful at that thing. And the same, you want to have kind of, we call it product market fit or insight market fit. You want to see a problem or have an insight that you really do believe like there's real value in. And the reality is, when you're building a business, ultimately a big part of it is you're trying to create economic value, and you can only capture the amount of value you can capture is a derivative of the amount of value you create. And that will come down to the core insight of what you're building and the market you're in. So therefore I would think about, okay, what's what's a market that we're really excited about, we find really interesting, we think we're really knowledgeable on, and related to the previous presentation, it's amazing if you're your own customer, because suddenly you have a real wealth of insight. We started a payments company initially with small businesses. None of us had ever really run a small business of that type that was collecting payments. We had no clue. And again, there's your greatest strength is your greatest weakness. Like, yeah, we had no clue, so that was a massive weakness. But at the same time, I remember we had no, like, a blank piece of paper, and we were so willing to listen to customers and really build. And then to your point of, like, how do you know? Ultimately, it's going to come down to, you do all the work, right? You should be analytical or take the approach you take to get to, like, really good answers. But ultimately, I find, and maybe you had the same as Tara, like, of all the ideas you look at, there'll be something where you just, like, in your stomach or somewhere, you're like, I've got to do this. And it's the most, I heard someone say this a while back, and I thought it was such a trite, cliched thing. I can't believe you said that. But they were right, which is, the time to start a business is when you can't not start a business. And I mean that in both the macro and the micro sense. The micro sense is, you've got this idea that you just can't get out of your system. I think sometimes it's quite healthy to try and get out of your system and say, okay, I'm going to write that down, or get it out of my head, I'm going to leave it, and I'm going to step away and do whatever. And if you just keep coming back to it, then at some point you've got to do it. And I think there's a psychological beauty to that as well, which is, like, once you know that you've got to do it, you know you can't leave that thing alone, then, well, it wasn't even a choice. So if it doesn't work out, it's like, well, I had to do it. So, it was never an option that I didn't. So that's where I get to. But my last point would be, I would have an incredibly high bar. Building business is an amazing endeavor. I think you should do it. The experience is amazing. You got to remember, the vast majority of people fail, especially when we're talking about venture outcomes. You want to build $1 billion business, like, the vast majority of people fail. Those that do not, probably the biggest factor is luck, like, honestly. So this is a huge risk. And I'm looking at this room here, and there's a ton of incredibly smart people here. And depending on what you want to achieve in life, whether that's experiences, learning, again, I go back to fun, learning, and impact. But if we be a little bit crude and go to economic terms, probably, no, definitely the median and the modal outcome, if we took you guys in terms of earnings and returns, would be better if you did not go and build a startup, because there'll be tons of corporates who want you to do stuff. The expected value is slightly different, because the outliers are so remunerative that they skew the results. And that's what takes me away from just that crudely economic sense. There has to be the other side of the psychological need to do it, and the desire to learn, and the desire to have that experience, such that even if you did it and you failed, it would have been a worthwhile endeavor, irrespective.
Back to the timeline, when did you go to YC? What was your experience there?
We went summer 2011. We had a fantastic experience.
Paul Graham and Sam Altman at the time?
Yeah, our two advisors were Paul Graham and Sam Altman, which we didn't know how lucky we were at the time. It was, I think it was relatively early, but not super early. I can't remember, maybe they started in 2007. So there was certainly a number of UK companies that had gone before us that were kind of our forebears. So Ian Hogarth and I think Pete from Songkick had already gone. Corvair and Harj Tagger, Harj is still there, had gone, like, really early. These guys were so out there on the curve of hearing about this thing. And it was an amazing experience, because it really was a different path for us. We, from the get-go, saw ourselves as our competition are the founders and the companies in San Francisco. Even though we came back to build here, that was the ethos of how we wanted to build businesses and the people we wanted to kind of match ourselves against. And that really, marked us out as incredibly different to the companies over here. I bumped into, funnily enough, last year, I bumped into a founder who built a really successful company, a fintech company in the UK. And it was like a bar somewhere in Europe. And he was like, oh, I've never met, like, really fun to meet. And he's like, we used to come after you, and we looked at you and we're like, how the hell did those guys get that valuation? We think our business is as good as theirs, and we're getting this valuation. And, we really, like, used you as a motivation to go on. And I just didn't mean to be nasty, but it was so funny, because we looked at Stripe. That's who we saw as our competition. That's who we were going after. Like, we were only ever looking at San Francisco. We were only ever looking at the best companies in the world. That's who we marked ourselves against. That's who we wanted to try and compete with, in terms of the amazing things they did. Not just the business outcomes, but the way they thought about talent, the way they thought about hiring, the way they thought about developing people, like, all of those things. Like, that was how we did it. And going to YC was like a symptom of that, and then also something that pushed that. And then the last thing I'd say is, YC was different then. Like, I couldn't really raise money as really young founders, especially young technical talent, couldn't really raise money, especially in somewhere like London. And then you had these people who were espousing a different way of building businesses, which is founder first, engineering first, product first, back smart technical talent to go and build really interesting things, where everyone else in the world was still, at the time, the VC ecosystem in Europe was still not far beyond. In many places, there was still some, there were some fantastic investors. Axel, as you said, is great. They've been around for now 25 years in Europe, but the like modal or median VC was still like, would ask you for like a business, a 5-year business plan at that point. And it was kind of the I called it the catch-22 business plan, because if you put something in front of them that was credible, then they tell you it wasn't ambitious enough. And if you put something in front of them that was ambitious, they tell you it wasn't credible. Yes. Oof. Well, what am I supposed to do? What's the investable plan? Just tell me what that is, and I'll give that to you. And there were very few investors, and we were lucky that we found YC. We also found Axel, who invested us at seed, and a couple of other great investors from the ecosystem that supported us. And to your question of, should you raise money really early? I think it really depends on the path for the business. One of the things I always think you should try and do is think about what are we trying to achieve here? Like I said, what are the things we care, what are the things we want to, what's the path? And I would say there is a big difference between the VC path, which is, we're shooting for these mega outcomes, and then more of the bootstrap path. And I think it's quite important that you're honest with yourself at the beginning as to which of those you want to do and what your reasons for building a business are. There's a great book on this. I think it's like Noam Wasserman, which is called like Rich or King. Do you want to be rich or king? Which basically you can either be king, have control of the empire, but you do that typically by retaining control, not sharing ownership, not necessarily taking investment and having others come in, not giving away equity to other people to come into the business. Or you can be rich, which is in a broader sense, which is you can try and build the biggest possible thing. And that means giving away some to investors to give you some cash, giving away to get amazing co-founders, giving away to get fantastic employees who can all come in and hopefully help you build something, much more successful and much more powerful. And the assumption is most people think that you can just do both. And actually you can't. The very fact that you have so few Jeff Bezoses and Mark Zuckerbergs is that managed to be rich and king, they're like the exceptions that prove the rule. I think that's an interesting thing for you to start before. It's like, do you want to be rich, or do you want to be king? And rich is not in the economic sense, it's in the like how big is the ambition here. And if that's the goal, then I think you should absolutely raise early. If it's not, then I'll be really thoughtful about that path, because once you start raising and bringing in other people, you'll need to make sure that you're all aligned with them in terms of the outcomes that you want to achieve. And then in terms of when to bring in capital, I think the big thing for me is before you take money from other people, you really need to know that you're in this for the long haul. And part of that is I've always felt an obligation that if I've taken someone's money, then I need to deliver on that. I need to show loyalty and really work my ass off to do the things I told them I would. But actually, even taking a step before that, your biggest and most precious resource in this life is your time. That's all we have. That's all any of us ultimately have. And once you take money, you are committed to doing this thing for a potentially, 14 years later, GoCardless is still going for a long period of time, if it goes well. And I think that's the bit that I would need to be convinced. So you need to be really convinced that there is something that deserves to be built. And that's the bar that I use when I'm thinking about starting something. It's like, okay, is there a product or a business here that I think needs to be built? This needs to exist in the world. And if not, perhaps that's not something you should be doing.
What mistakes have you done in the first fundraising that you've done, and how did you change your approach over the years?
In terms of investing?
In terms of raising for your company before you become an investor?
And then just remind me, what was the first bit of the question?
What mistakes have you done?
Mistakes.
You raised from the beginning.
All of them. There's many, but I'll start with a couple of kind of meta ones. The first one is probably just not understanding how VC worked as an industry. I think that's a useful thing that's worthwhile for everyone to understand, which is once you understand that people are looking for power law returns, so, in order to, typically a VC, we'll use some very crude numbers, would, a good VC would want to 3x their fund. That would be over the course of, 10 to 15 years. Let's say they had a 300 million fund. They would invest half of that in first checks, another half in follow-on. They'll make 30 investments. You can run through the math, but in order to get 3x, especially after fees, etc., you have to quadruple your money. The vast majority of the returns will come from the top performing company, and if that one will normally return the fund, and then the second, and then the third. Once you understand that, you understand that actually it's not a rational business. It's kind of a high beta business where you could have someone who's great and you think they're really good and they're doing something that's going to be successful and do really well, but the return profile on that business could never be an outlier, and therefore you would not invest. Then you have a second person who's a bit crazy, maybe a little bit all over the place. You don't know if you can believe what they're saying, but if they're right, it could be phenomenal. And that person will be disproportionately more likely to raise money. And I think that was something that I didn't understand in the beginning. And I'd see smart people with sensible ideas, etc., unable to get funding. And then people that I thought were not credible, that were kind of doing crazy and talking about doing things that I did not have any belief that they could do. But when you take a step back and look at what people are looking for, you understand why that might be the case. So that's the first thing I'd always understand, and that helps you figure out if there is an alignment between what you're trying to achieve and what the investor is trying to achieve. And I think alignment is really important. It's not about understanding it so you can trick yourself into looking like the thing they're looking for. It's actually more about making sure that there is alignment between what they're looking for from the business and what you're looking for from the business. Because if not, you're just storing up problems for future. So that was one, not understanding enough. And I think you should just understand the venture math, the math behind a venture fund, if you're considering going that path. And then the second one is counterintuitive. And there are many people that have probably found the other side, but when fundraising, often we and I've seen many other people do this, you kind of worry about leaving money on the table. You want to tell people the maximum amount, you want to raise the maximum amount of the maximum valuation. Now, there's a whole reason why that's not what you should do, but we won't get into that right now. But once you start with that as, okay, what I want to do is negotiate the most competitive round I can, you worry about anchoring, you worry about starting too low. And we had various rounds where that fear led us to starting with a really high number, and then going out to market and consequently not generating a competitive dynamic because we started too high, and then kind of having to go around with our tail between our legs, telling people actually we're raising a little bit less at a little bit of a less valuation, in an industry where actually people are looking for outliers. They're looking for things that generate excitement and momentum, and you're by definition showing them the opposite. Like that's not a good mechanic. And actually the opposite is a much smarter approach, which is to start lower than you think even you can achieve, such that everyone you talk to is getting really excited. Suddenly you have a really nice competitive dynamic and you're pushing things up. And like logically, the proof of that is, if you start too high and you keep dropping until you only have one investor, well, by definition, you do not have a competitive dynamic. Whereas if you start too low and you have, more than one investor, you already have a competitive dynamic to drive a much better outcome. And that was my learning. Like, better to start low, create a competitive dynamic and drive it up. And then everyone gets really excited about the thing they want to be in rather than be the thing that the opposite.
And I want to ask about the last question about GoCardless. At what point did you know that it's going to be a big business, and how did you tell?
Oh, that's a really good question. I think it's something interesting about it is our customers knew before we did. So there's a tweet. I always think you should give credit where credit's due. There's a tweet that like, before any of us ever thought this, before we were ever really anywhere, from a guy called Dwayne Jackson, who was one of our first partners who integrated our API. He built a business called Cashflow. Here's a really interesting backstory, actually. If anyone, you should go look him up and read about him. Really interesting guy. And he put a tweet out saying, like, putting it here first or whatever. And I'm sure the enterprising when you can find it, like, GoCardless will be $1 billion company. So you can date that. And we all saw that and we're like, I don't know what the hell Dwayne's smoking, but he was right. And the reason is he saw the problem, he saw the need, because it was him and his customers. That was a long time before we did. And then the other thing I'd say that's interesting, that's an indirect answer, but I don't need to be too presumptive about success. We're doing really well, really happy with the business, etc. But something I've observed and learned over time is every business, in my experience, faces like an existential event every year of its existence, and they're just lucky if they realize. There's some really big businesses that are having one like right now. They don't even realize, and it'll be fine for a couple of years, but in like 3, 5, whatever many years, they're dead, and they won't even they haven't even realized. And it's the same in growth businesses, and you see this. Like there are moments every year that if you get it right, then you unlock future growth, future potential, etc. If you get it wrong, if you miss the moment, if you didn't see where the opportunity was, you just killed it. So that's something I'm cognizant of in every business. You should never take anything for granted. It's all about continuing to provide an amazing product and service to your customers and creating a ton of value for them. And as markets change, as customers' needs change, like that can go away.
And as a second-time founder, what things did you change in your approach when launching Nested? And there's also this contrarian thing that usually people do exactly the opposite things that they did in the past, and usually those ones don't work either. So can you run us through some of those mistakes?
Yeah, that's an interesting phrasing of the question and somewhat correct. So I wouldn't say I did the opposite, but I definitely overcorrected. And I think there's a couple of things underlying this. The first one is, as you build a company, every stage of a company, your role changes. And this is the amazing thing about building a business. If you're a founder, your job literally changes, especially if we're going like every 3 months, doing a completely different job. And suddenly back to fun, learning, impact. It's so much fun. You're learning so much, and you feel like you're having a ton of impact. So that's amazing. But then if you fast forward, if you're building a business for, however many years, and your job's changing every 3 months, then you go back to start another business. Well, the job you were doing at the end is so drastically different to the one that you were doing at the beginning that there's, you actually, you don't even realize how much you've changed, and you have become a far better operator, a far better executive, far better manager, far better at all of these things. And it's objectively true. But you have to understand that many of those things are not relevant. Like they're there for a different job. Like you're great at a different job. Some of them are applicable, some of them are not. And that was one thing that I missed. And then that I didn't necessarily correct for sufficiently, I would say. And then the second side of the overcorrecting side is I did look back hard at the initial stages and who I was in the initial stages, and the things you got wrong are the most obvious to you because they're the things that you took feedback for, they're the things that you felt yourself. And to your point, they may or may not, the alternative may or may not have been better. So I'll give you it's a really good but a really bad, dangerous example. First time out, like building GoCardless, I was a complete pain in the ass. Like as a manager, I didn't manage anyone before. Working with designers, I was a nightmare. Like with a designer, the brief generally is like, you should give a designer a good, a great designer. And we were really lucky with some fantastic designers in the early days with GoCardless and still today. You should give them a problem. You should go to a great designer with a problem, not a solution. That's the opposite of what I did. Like I went to them with like the exact solution of exactly what was required. And then they would go and be like, no, this is what you need to do, which is terrible. And consequently, there are designers that I worked with in the early days of GoCardless that hopefully would say, I think that's good and I think it's smart, I think it's whatever, but I wouldn't want to work with him again. So it's cognizant of that. And second around, I was like, okay, no, I've learned how to be a great manager. I've learned how to do all these things. I've learned how to like empower people to go and do amazing things. But in the early days, you are the person with the insight. You're the person who knows the whole business, who is so close to the customer, who knows everything. And actually, there's a real danger. If you get too far away from the solution, then it's going to be a weaker solution. And therefore, second time out, I empowered lots of people. I trusted them. I got good talent. I gave them whatever. But they didn't have the same drive. It's kind of impossible. They didn't have necessarily the same insight, the same relationship with the customer, etc. And as a result, the answer was worse. The experience is way better. They loved me. They thought I was an amazing manager. But we didn't get as good results. As this is not a way of saying like, I was right. That's not the point. The point here is that actually, there are some that you got to think about what you're optimizing for, and As a manager, much later in the business, where the vast majority of the output comes from the team, then you should be absolutely optimizing to create an amazing, empowering environment for amazing people where you can maximize that function. In the early days, when potentially the vast majority of the output can still come from like the key barrels and key people from within the business, then you should be optimizing to maximize the output that comes from those people. So those are a couple of thoughts.
How intentional were you about team culture in Nested, and how did you apply that?
Yeah, this is an interesting area actually. We were incredibly intentional, but we didn't write it down. It's kind of we operated by convention, and we had this. Everything you do creates culture. So here's the example. Some people asked us about culture in the early days, and the thing I used to say, which is probably like no longer appropriate, but was like, we don't even, we don't even know we're going to be alive in 12 months. So like, why the fuck are we going to spend our time on this? Like, I'm spending all my time on making sure like I'm actually alive, and in a way that's like not creating a culture because you're explicitly not writing anything down, explicitly not saying anything. But at the same time, that's an incredibly strong culture that you're creating, which is like, no, we're action oriented. We want to get stuff done. We want to focus. And therefore, there are a number of those things that emerged in the way that we operated and the way we built that business, especially in the early days. And, your culture is kind of the way you behave times by the people you hire, times by the way that you onboard, manage, train, reward, motivate, hire, fire, promote, fire, times by events of what happens in the market. Like this, some lazy formula, and that's what gives you like your dynamic culture. And then another side, which is the deliberate side, where you can write it down and then try and like create that thing. So in GoCardless, we were very, we were not deliberate. We ended up with probably half of the culture we intended to. And then over time, there's a point where it got big enough that we realized we had probably, half that was not necessarily what we intended. And then that's a little bit of a painful process trying to get, once you're a living, breathing entity, imagine me in this room trying to say, hey, everybody, let's try and find 5 values that we all believe are the right, or even 3 or 5 values that we all think are the absolute right core kernel things that we should be thinking about in everything we do all day. That's pretty difficult, especially when you signed up to something that you thought might have been slightly different, or the manager that hired you or the person you spoke to promised you something slightly different. So a little bit painful. Whereas in Nested, we took the opposite, which is even before I started, I had the values and I used them basically as a lens for bringing people into the team. And that worked incredibly well. But again, sets a bit of a culture. It sets a slightly more thoughtful culture, which your greatest strength is your greatest weakness. If you're really thoughtful, then you might not be action oriented enough. And there's a moment in that company where I had to go and we had them all up, the values up on the walls on like posters, and felt like we just got a little bit corporate, a little bit slow. And we literally went and like crossed one out, and just there was a big poster, beautiful poster printed by our designers. Designers must hate me. And we just crossed it out and just wrote bias to action on it because we just weren't getting enough stuff done. And again, like that, I didn't talk to anyone about that. It was just, I could just feel it. And, maybe I spoke to my founders. It was like, we got to make a change. And when you go and do that, when you go and cross something out in the middle of the office and like write on it and don't change that poster, like that sends a really clear message.
And at what point did you start investing? And how can you tell what's a good team or a good idea to invest in?
Good. Quite a few years ago now. I don't know. In fact, did it in 2 waves. I initially started investing a long time ago. I don't know, 8 to 10 years ago. But it was with a view that I knew that at some point I would want to angel invest. And I didn't want the time that I angel invested to be the time that I could not angel invest, i.e., I see the most amazing company founder investment and I want to invest. I didn't want that to be the first time because then I wouldn't know what I'm doing. And if that's the one where it really matters, if you get it right, then you don't want that to be the first time. So I intentionally went and wrote a couple of checks into interesting people or places and then stopped and just saw how I felt about those investments and what I learned over a couple of years. And it was like 3 investments, it was nothing. And that was amazing because I felt completely different afterwards. And I learned so much from doing it. And then I came back properly, I don't know, 6 years ago. A big part of why I invested was because the ecosystem has improved a lot from when we started, but there was still not that many people around that I found really, really useful. And I essentially wanted to be that angel that I'd wanted as a founder. That's really why I started. And part 1. Part 2 is because a friend of mine who's one of the smartest people I know, an astonishing person to work with, wanted to angel invest too. And he said to me, "Hey, why don't we do this together? I think we'll do way better. We'll learn way more, and we'll have way more fun." And I thought, yeah, that's great. And then part 3, because I find business incredibly fascinating, and I thought I'm gonna learn a ton from doing this. And then to your point on how to distinguish on teams, I actually, again, I think differently to many people. I think that's way tougher than most people give credit. Like, a lot of people think, especially when they're investing, think my job is to find the best possible founder, and they presume that they can do that. The challenge is that there are so many different founder archetypes. At some point, I should probably sit down and like figure out what they are. But I think you can easily recognize the archetype you are yourself. So, there's the product, there's the technical genius, there's the product visionary, there's the hard charging operator, there's the incredibly savvy commercial person, there's the industry expert, there's like the customer with the problem, there's all of these different archetypes. And the challenge is that what looks great in one, you may be absent or the opposite in one of the others. So and you saw this in investment a certain while back, where everybody was just investing in the same people that looked the same. It was all kind of same age, white, male, Oxford, or Oxbridge or Redbrick University, probably worked at McKinsey, Bain, Goldman, or whatever, just getting all the investment. And it was because the people they looked a lot like the people that are investing. So they looked.
The question is, did that work?
Yes, but probably not for the reasons it should have, which is like if you want to make off-market returns, you need to go into uncommoditized asset classes, and I think angel investment was so uncommoditized at that time. There were so few people doing it that the valuations were so low that with almost any hit rate, you could make really fantastic returns. That's kind of been driven up over time. Bringing back to the main point here is just, I think that with those different archetypes, you start looking for this, super smart analytical operator, or suddenly you miss the product visionary, and suddenly you miss all of these other archetypes. And actually, that is a phenomena that you notice in the industry. If you look at some of the biggest businesses to come out of Europe or globally, those founders found it incredibly difficult to raise early rounds of funding because they didn't necessarily look how people thought they would look, or didn't necessarily behave how people thought they would behave. So the short answer is, I find it really difficult to assess people, and I do it with kind of a great deal of reticence, and then really try and, again, figure out, well, back to the things I said that people should think about with their own businesses, like, well, what is the founder market fit here? That's a lot easier than trying to figure out. It's like, okay, are they a fit for this market? Are they the right person? Do they have, even before I assess how strong that skill set is, like, do they have the right skill set for this opportunity, to have the right instincts for this market, etc. And and then from working with them a little bit, you start to get a feel for, is this someone I really want to work with?
And how does investing change between being an angel to being a VC?
It's much harder. Is the honest answer. As a VC, you have to. As an angel, you're in a fortunate position where you don't have to compete with anyone. Like, as I said, I wanted to be the kind of angel that I wanted as a founder. I can be your not so your best friend, but I can just be completely candid with you. I don't have to compete with anyone, and therefore, when a round comes around, Axel, Index, Sequoia, all the top funds have to fight with each other, and all have a very strong win rate, but they've still got to compete with those. Whereas I can just sit back and whoever invests, I'm coming into. So you can get into all the best companies, which makes a huge difference. You also have a number of advantages in terms of the ability to sell secondary along the way. You don't have to continue to invest necessarily, which VCs do. Once you're committed to a business, you have to continue to support and do your pro rata, etc., which you need to factor in from the get-go. And also, you have a completely different relationship. As a VC, you've got a lot of hard yards to do. Whatever I do, whenever I work with someone, I want to have a really, I always like want to be like net positive, right? So whatever my overhead is and whatever the value add I bring is, I want to make sure that's net positive for people. And as a VC, the challenge is you immediately do bring a level of overhead, right? And rightly so, because you're investing a lot of money. You need to take a board seat. You need to bring various things in. That means you have to work way harder to make sure that you're net positive in terms of the value you bring. And that's what the top firms do. They will work incredibly hard to do that and to bring their network to bear, to bring their experience to bear. in a number of ways. As an angel, the first thing to do to make yourself net positive is make sure you have zero overhead, right? If you stay the hell out of the way when you're not needed, and then you're just there and really useful and really responsive when you are needed, you're already into a good position. And I obviously try to do far more than that, but it's much easier in many, many ways. And also, you don't have to do all the tough stuff of, as a VC, you have LPs who it's incumbent on you to take very, very seriously. You have a responsibility to them to go and deliver returns. Whereas as an angel, your only responsibility is to yourself.
I want to ask a couple more questions and then do a Q&A for maybe 10 minutes. Being an Imperial, what should students work on?
Sorry, say that one more time.
What should students work on?
Honestly, whatever they want. My daughter, I tell her all the time, life's really easy. Everyone makes life way too hard. Okay, really easy. You want to be happy, you want to be successful. It's basically the same formula. Find stuff you're good at and you enjoy, because you'll love doing it, you'll want to do it, you'll invest your time, you'll get great at it, and that tends to be how you become successful, and you enjoy yourself. So honestly, like, I wouldn't be too directive of like, oh, I want to do this and therefore I should go and do this course over here. Like, do the thing that you find genuinely fascinating. And give a really random example. I've always, done a ton of sport and tried to stay fit. And in the gym, you meet these people who are incredibly passionate about the gym and weightlifting and various other things. And they could tell you all sorts of stuff about the science behind building muscle, etc. And it always strikes me like, I bet this person like hated, GCSE biology. But now some of the processes they're talking to me here, they have an unbelievable understanding. And it's because they found the passion, they found the way of unlocking this way of learning, that they're dealing with incredibly complex information because they're passionate about it, because they care, because they want to do it. And that for everyone here, like, and I had a recent experience of this when I did something to like build a skill set that I don't necessarily possess as much as I do, or not one of my key skill sets. And man, it was sucked. Like, I realized how much I'm really good at what I do and I love doing it. And consequently, I have fun every day and I want to work and I work incredibly hard. But spending like just a couple of weeks working on something that was not natural to me, that I was not very good at and I did not enjoy, sucked. I got to the end of like each day and I was delighted. It's like, God, thank God I don't have to do that anymore. And that's the opposite of how life should be. So honestly, like, find stuff you're good at and you enjoy, and life will be a joy and you'll be incredibly successful.
And you advise your younger self on how to start a company. What's your advice?
I don't know. Honestly, you change one thing, you change everything. I've had such a good, fun ride. And I think it was really lucky, but more than smart, in figured out a few things early on, or was taught a few things early on from people that made all the difference. I think I got great, or like certain things my parents taught me in terms of how to behave and values and various other things that I think were great, and I'm really proud that I had those and they helped me do the right thing. And from my co-founders, from my jobs, I kind of figured out that actually the people make everything. You work with the right people, you become the average of the people that you surround yourself with, and you have amazing people, you can do amazing things, and I think that was important. And then there was one more thing that I got really lucky that I learned, and I think maybe I learned by accident. And actually, the person who taught me this, it transpires they don't actually subscribe to it, but it was an amazing lesson for me that's really stuck, which is, so these are more things. I don't know is the answer to that question, but why can't you? The things that I'm glad that I did learn, that I'm glad that I did do or get right. And they're all largely accidental, but one was like, life is not a zero-sum game. So many people treat life as a zero-sum game, and it's like, well, for me to win, they have to lose. And I just hate that way of thinking. And all my experience in building businesses was the opposite. Was actually like, if I can find a way for them to win, then I can probably win too, and maybe I can win bigger. And that even came down to negotiations with customers or big partners, hiring and working with people, everything. And it's also way more fun than trying to eliminate everyone. And the other thing, and this is really risky, that we kind of got right, but you should be careful on listening to me on it, is we started a business really young that worked out very well for us. And it was great because it only gets harder over time. You have more responsibilities and more commitments. I'm quite careful with this advice though, because you got to remember the vast majority of people who do this, it does not work out well necessarily. But what I would say is if you do want to start a business, I would just be cognizant of that it does, by definition, like I always think of like the science of the physics of the world and everything that surrounds you, right? And by definition, it gets harder over time to start a business. Everyone thinks it doesn't, but it does. As soon as you think about it for a second, it does. And therefore, if you really want to start something, there's an asymmetric risk in not doing so. And therefore, I would start at the earliest possible opportunity is one way to think about it. And then the other thing I learned later, that maybe this is what I would tell myself actually. Again, it's back to just thinking about the physics of things in life. I love asymmetric upside, and I try and expose myself to that as much as possible. And I hate asymmetric downside, and I try to avoid it as much as possible. And it's why I don't do skydiving, because it's like, yeah, I'm sure that's great most of the time, but if that goes wrong, I'm dead. So nah, I don't need that. Whereas in investment, like if I invest in a startup and if it goes wrong, I lose 1x my money. If it goes right, I can make 10x, 100x, 1000x my money. So I'm happy to take asymmetric, expose myself to asymmetric upside all day long. Asymmetric downside, no, thank you.
Do we have a microphone to do questions? Yes, super. Who has a question?
Thank you very much. So I wanted to first thank you for your insights, specifically your outlook on life about maximizing fun. I really do like hearing that from someone so successful. My question is mostly about something that I would want to do in the very near future, where I'm starting my own business as a B2B. And my plan is to go to my potential customer, sign the contract, get the pre-revenue, so get the money up front, use that money to set up my manufacturing facility, and then fulfill the contract at a later date. And my question is, what would you advise I consider when proposing this type of deal to my customers?
Very specific. If you can make it work, that's awesome. That's a fantastic way. A lot of people miss that one of the most important things of business is cash flow. Business is only as valuable as the cash flows it creates, and that's beautiful because you're lining everything up. Maybe a generic insight I would think about, and it really depends on the space you're in, so you've got to be a little bit careful here, but your early customers, I've always thought of them as icebergs. The bit they'll pay you is the bit above the water, and actually the bit below the water is far bigger, and that's where a lot of the value of your early customers comes from, which is credibility to get more customers, the feedback they give you about the product, the credibility they give you, like helping you build out your bug list, your product roadmap, etc. All of those things. So the one thing I just think about there is what you described sounded like a slightly transactional relationship, which you can achieve and that works and makes sense. Great. I might just think of it as a slightly more holistic relationship of actually there may be more to this than just getting the cash and the revenue, and I might be able to give a little bit more to get far more in the long run, would be the one thought. But again, it's very difficult with little context to say smart stuff. So apologies if I didn't.
Firstly, thank you very much. That was very insightful. I also think I have to give you some background info about myself, because I'm actually not a student here. I'm a student at London College of Fashion, and I'm doing a entrepreneurial master's course as well. And my idea is to build like a sustainable and solution-oriented underwear brand. And my question is really about the funding part, because as far as I know, it's a very male-dominated field still. And obviously, you would probably be my customer when it comes to bras and solution-oriented underwear. So like, if I were in the situation of actually going into a funding round, how would I not lose you or your interest in funding my business, basically?
Good question.
Thank you.
I think people are open-minded. I think people are open-minded enough that it's not the case. If it's a good business and a well-communicated problem from a credible person, then you can invest in all sorts of stuff. Like if I look at my angel investment, I've invested in like or almost anything from really boring SaaS apps to subjects that I have no real knowledge of, but I met, invested in like menopause apps, right? I know very little about menopause, unsurprisingly. But I met an amazing person who really was passionate and driven, and I felt like they could do something special, and they had a unique or compelling insight as to what they were doing. So I think if those things are communicated, then you stand the best opportunity. That's the vague answer. And then the concrete answer is, the key is to make sure you're talking to the right person in the first place. So the thing that I would do is go and look at the kind of companies that you like and want to be like, and they're in a similar space, a similar geography, similar stage, similar approach, and have a look at who funded them. Because by definition, they funded this kind of thing before, so they're clearly interested in the area. Also, by definition, if that's a brand that you like and think is really cool, then probably they've been quite successful. So those people are going to be particularly receptive to those kinds of ideas. And having been involved in them, by definition, they'll probably also be that much more useful. So that would be like the concrete thing I would do.
Cool. Thank you.
Good luck.
Thanks.
Hi, thanks again for a very insightful talk. So everyone is talking about how to assess startups and founders for them to get funded. My question would be from the other side: how should we startups assess investors to have a really good investor founder match, especially when we are talking about early stage investment? Thank you.
Yeah, really important area. So first thing is alignment between what you want to achieve and what the investor wants to achieve. Even two people who have completely aligned values and approaches, etc., if you have different goals, will have a problem. There's the Charlie Munger aphorism of, show me the incentive, I'll show you the outcome. So that's the first thing I'd look at aligning. And then the second thing is the thing I said earlier of trust, respect. First off, find someone that you trust. Second, I need someone that you like, because working with them for a long time, and if they sap your energy every time you come across them, that's going to be extremely unhelpful. And then third, someone ideally that you respect and rate, and you think they bring some value to the endeavor.
So I feel like there are a lot of startups right now happening, but when you look at most of the deals, there's same few deals you see in the news, right? Like same few deals being passed around by top VC firms. And I feel like these days, I feel like the seed stage investments start to resemble kind of growth stage investments. The valuations are really high towards some of the AI companies are raising 100 million in their seed stages. Do you think the VC model is changing these days, or do you think it's just an anomaly of the AI thing?
Yeah, that's a tough one. So it's definitely changed. It's definitely evolved. When I was first building GoCardless, I didn't know you could achieve these kind of outcomes as businesses. I remember when I was in YC, they were celebrating their best, I think it was to date, their best ever outcome. It was a company called Heroku that had sold for something like 170 million. And this was an astonishing thing. And it is amazing. And it's a cool company and a really cool product. But now Y Combinator have companies, that considerably worth 100 billion. And when you change what the achievable outcome is, the exit price, that drastically changes what you'd be willing to pay as the entry price. So I think that's one thing that has changed over time. The second thing is that seeing, both from the ZERP and the interest rate phenomenon, it made the industry way more attractive. Lots more dollars came into it. We know what demand supply curves, we know what they look like. We know what happens when you shift one and the other, and that has certainly happened in the space. And I won't fully go through everything, but then a third thing I would just note is it can also be a lot more nuanced than that, which is certain businesses require a certain amount of capital. So for example, people looked at foundational model companies that started and their first round would be $50 to $100 million, and saying, well, that's crazy. How can a company start and raise $50 to $100 million when it's got nothing but a few founders? This makes no sense. But actually, if you're building a foundational model company, it makes even less sense for them to raise $10 to $20 million, because they can't actually get anywhere with the capital. The first thing of an investment round is it should be designed to get the company to the next inflection point. And therefore, for certain businesses, actually, I think raising really large amounts of money where the conceivable upside or outcome is really huge, then it makes absolute sense that they should raise. But there definitely have been lots of high valuations, but that is is a derivative of demand. It's a derivative of competition, and that creates those things. Is also an outcome of the industry, which is when you have lots of people fighting over few outlier companies, it can drive lots of ostensibly irrational. If you take a VC fund, even with sensible pricing, if they're going to invest in 30, 35 companies and they're going to make all their returns from 3 to 5 of them, well, then 30 of those were bad deals, right? So you look at that and say, well, 30 of those were terrible deals. They were overpriced. They paid too much for what they got out of it in the end. But then the other 5 were so theoretically underpriced that it paid for it. But in that world, you're looking at 30, and it's why I always laugh when the FT writes stuff about startups and growth or whatever, because they tear down, oh, they got it wrong on this 1, 2, 3, 4 occasions, but they fail to see that, well, in that example we just described, that VC fund that makes all their money from 3, or let's say it's 3, they just need a 10% hit rate to be right. So you can write 9 articles in the FT about how dumb they are, but as long as the one where they're smart, they're really, really smart, then it doesn't matter. And I think that is just an important nuance of those 2 are just interesting nuances to have. That being said, I largely agree with your push.
Let's do the last one. I think it's about time, correct?
Hi, Matt. So you mentioned initially that a good filter to have when you decide what to build is why you're the best person to build that thing at that given point. But you also mentioned when you started off first with GoCardless, you didn't really know what you were doing. And it's the first time you're probably playing in that market. So how did you justify that?
Yeah, so actually inadvertently. So it was true, but inadvertently true. Funny story is we met a guy called Max Levchin who founded PayPal when we were starting GoCardless. And his main piece of advice was not to. Which is interesting when a titan of payment startups tells you that you should probably not do it, and you, knowing nothing, thinks you probably should. Turns out in probably this one case we were right and Max Levchin was wrong. But even a broken clock's right twice a day. The reasons that actually we were the right people were because we were the only people who were looking at this industry with a product first perspective, and who were actually trying to build a way better product. Whereas everyone else was just thinking in commercial terms of everyone else was thinking, how do we capture value? We think, how do we create value? And we didn't know at the time, but that made us right. It meant that we built a far superior product to anyone else in the industry. And eventually we learned how to sell it. And then that meant that we became the number one in the industry. So it would have been even better if we were deliberate about that, right? And we came to the market and said, hey, everyone else in this market is coming at it with this perspective and we're coming with this approach, and that's why we're going to win. We didn't. We got very lucky. Thank you so much, everyone. I hope there was something vaguely useful or interesting in there. Thanks, Mo.